Welcome students. This is a program for third year Bachelor of Commerce in the subject of Economics, semester 5. The course code is CEC 103 and the course title is Indian Monetary and Financial System. In this module, we will be looking at financial markets and the module name is Capital Market Instruments. I am Mr. Akhil Gavas, Assistant Professor of Economics from Government College of Arts, Science and Commerce, Sankilim, Goa. In this module, we will be studying about capital markets and instruments that are traded in the capital market. At the end of this module, you will be able to understand the meaning and working of a capital market, and also you will be able to understand the different types of capital market instruments. Capital market is a market where long-term funds are borrowed and lent. The primary purpose being directing the flow of savings into long-term investments. Capital markets deal in long-term claims that have maturity period over 1 year. Let us look at some of the instruments which are traded in the capital market. The most common instruments are equity and ordinary shares, preference shares, debentures and bonds. Along with this, we also look at financial derivatives. Let us start with preference share. Preference shares allow an investor to own a stake at the issuing company with a condition that whenever the company decides to pay dividends, the holders of the preference shares will be the first to be paid. Dividend payment of the preference shareholders is fixed, and if somehow company liquefies, the owners of the preference shares will be the first one to get their money back after the company has paid back its debt. Thus, preference shares are those shares which fulfill both the following two conditions. They carry preferential share right in respect of dividend at a fixed rate. They also carry preferential right in regard to payment of capital on winding up of the company. These are some of the types of preference shares. First one, on cumulative preference shares, if any year the profits are insufficient to pay the preference dividends, then this dividend can be paid in the subsequent year before any other dividend is paid. In other words, the right to receive the dividend goes on accumulating till it is paid. In case of non-cumulative preference shares, the dividends can be paid only in that year. If there are insufficient profits, then such preference shareholders do not get any dividend for that particular year. Then we have convertible preference shares. Convertible preference shares can be converted into ordinary shares on terms and conditions fixed at the time of issue of such shares. A redeemable preference share matures in a fixed period of time, and for all practical purposes it is regarded as a debt security like a debenture. Participating preference shareholders can earn a higher dividend than the fixed one if the company makes good profit. Participating preference shares are entitled to participate in the surplus profit remaining after the payment of A. Fixed dividends to preference shareholders and B. Dividend to the equity shareholders. They are also entitled to participate in the surplus funds remaining at the time of winding of the company after payment of first preference share capital and B. equity share capital. Non-participating preference shares are not entitled to participate in the surplus profits or surplus funds left over at the time of winding off. Next is equity or ordinary shares. According to section 85 of the Companies Act 1956, an equity share is a share which is not a preference share. In other words, shares which do not enjoy any preferential right in the payment of dividend or repayment of capital are termed as equity or ordinary shares. The equity shareholders are entitled to share the distributable profits of the company after satisfying the dividend rights of the preference shareholders. The dividend on equity shares is not fixed and it may vary from year to year depending upon the amount of profits available for distribution. The equity share capital may be one with voting rights or second with differential rights as to voting. Dividends are otherwise in accordance with such rules and subject to such conditions as may be prescribed. Next is debenture. The word debenture has been derived from a Latin word called as debere, which means to borrow. Debenture is a written instrument acknowledging a debt under the common seal of the company. It contains a contract for repayment of principal after a specified period or at intervals or at the option of company and for payments of interest at a fixed rate payable usually either half yearly or yearly on fixed dates. According to section 2 subsection 12 of the Companies Act 1956, debenture includes debenture inventory, bonds and any other securities of a company whether constituting a charge on the assets of the company or not. Let us look at some of the types of debentures. Convertible debentures. Debentures which are convertible into equity shares or in any other securities either at the option of the company or the debenture holders are called as convertible debentures. These debentures are either fully convertible or partly convertible. Then we have non-convertible debentures. The debentures which cannot be converted into shares or in any other securities are called non-convertible debentures. Most debentures issued by companies fall under this category. Redeemable debentures are those which are payable on the expiry of the specific period, either in lump sum or in installments during the lifetime of the company. Debentures can be redeemed either at par or at premium. Then we have irredeemable debentures. Irredeemable debentures are also known as perpetual debentures because the company does not give any undertaking for the repayment of money borrowed by issuing such debentures. These debentures are repayable on the winding up of the company or on the expiry of long term period. Then we have bond, a debt investment in which an investor loans money to an entity, most likely a corporate or a government, that borrows the funds for a defined period of time at a fixed interest rate. Bonds are used by companies, municipalities, states and federal governments to finance a variety of projects and activities. There are three main types of bonds. First one is a corporate bond, then we have municipal bonds and last is zero coupon bonds. Corporate bonds are debt securities issued by private and public corporations. Companies issue corporate bonds to raise money for a variety of purposes such as building a new plant, purchasing equipment or growing the business. When one buys a corporate bond, one lends money to the issuer and company that issued the bond. In exchange, the company promises to return the money, also known as principal, on the specified maturity date. Until that date, the company usually pays you a stated rate of interest, generally semi-annually. A municipal bond is a bond issued by a state, the territory, it could be US territory, Indian territory, that is specifically a government. Then we have city, local government or their agencies. Interest income received by holders of municipal bonds is often exempt from the federal income tax and from the income tax of the state in which they are issued. Although municipal bonds issued for certain purposes may not be tax exempted. This concept is especially new in India. The first municipal bond in India were issued in the year 1995, while the first state guaranteed bonds were issued or launched by the Bangalore Municipal Corporation, okay, that is Bruhat Bangalore Mahanagar Palike in 1997. In 2010, the Greater Visakhapatnam Municipal Corporation issued bonds worth rupees 30 lakhs. Lastly, we have the zero coupon bonds. Now, zero coupon bonds are bonds with no coupon payments. Like treasury bills, they are issued at a discount to the face value. The Government of India issued such securities in the 90s. It has not issued zero coupon bonds after that. Example of zero coupon bonds include US treasury bills, US savings bonds, etc. Lastly, we look at financial derivatives. Now, financial derivatives as a concept is new to India. Financial derivatives are financial instruments, the price of which is determined by the value of another asset. Such an asset, that is the underlying asset, can in principle be any other product such as a foreign currency, an interest rate, a share, an index, or a commodity. Financial derivatives include various options, warrants, forward contracts, futures, and currency and interest rate swaps. Here are some of the references that you can use for your further understanding. Thank you.